Well, turning over to inflation, prices picked up again last month, potentially a sign that tariffs are making their way into the economy. CPI rising 2.7% for the month. Meanwhile, core CPI is up 2.9%. Is more upward pressure on the way? What does it mean for the Fed? Joining me now is Neil Dutta from Renaissance Macro Research. Neil, welcome. A quarter ago, you thought this tariff off again, on again stuff was driving us toward a recession because of the damage done. What do you think now?
I think it's still a reasonable expectation. I mean, if you take all the data on board, John, and you look at what's going on with core goods inflation, particularly outside of autos, that rose about 0.3% in the month of June. So there's clearly a tariff impact. At the same time, if you look at what the consensus is telling us about retail sales, excluding autos and gas, it's up 0.3, and that's a nominal value. So if prices are up 0.3 and sales are up 0.3, it basically means that real spending on goods is declining in America. It's not a particularly normal situation. And, the labor markets continue to cool. When you look at hours, how many people are getting jobs, and hourly earnings, that number is not rising at a particularly strong rate. So,
I'm really interested to hear you sticking to the potential recession call, because the market seems to have shrugged that off. We're just talking about how investors are sort of record bullish. I think a lot of institutions don't believe that the president wants tariffs to remain at the levels where he set them now. Paint for us a picture of how you think this plays out and how soon.
Well, I mean, I don't think it's always challenging to be fighting against the tape if you're an analyst. But, to me, I'm just, sticking to first principles. I see a labor market that's slowing. That means that consumer spending will likely moderate because disposable income growth is moderating. At the same time, you see
is that a holiday season issue? Is that when we should look for evidence of that?
I mean, these data are seasonally adjusted, so you should expect to see it now. I mean, I think it's highly revealing that things like hotel rates in the CPI data are contracting over the last several months. Why are services going down? Because people have to allocate more of their budgets towards goods and they have less to spend elsewhere, and that drives down the prices for services. If you look at the housing market, I think you can make a reasonable case that the housing market in particular is already in recession. You're seeing prices declining in major markets. Importantly, those are the markets where the builders make the homes. That's going to weigh on construction activity, which will in turn weigh on residential construction employment and probably durable goods spending a bit more. And state and local governments are continuing to tighten their belts. I mean, we just saw Chicago lay off 1,400 teachers. I mean, that's okay. News like that is happening all across the country. So
tell us then, what would be the next significant canary in the coal mine, data-wise, either on the macro level, on the micro level, that you think is going to tell us that this thesis of yours is playing out on still heading toward a recession, perhaps?
I think it's employment and it's income growth. I mean, ultimately, if you get the consumer in the U.S. right, more or less everything else falls into place. And if the labor markets are slowing, then it's a reasonably safe assumption to assume that consumers are going to slow down as well. Home prices are declining, and that's the most important asset on the balance sheet of most consumers.